So, from the last part, we left on scope. So, let's start from there itself. As we talked about, that goals are the most important things as to why we are planning or what we are planning for. Not all goals have same priority for the client and in general. Like for short-term goal, a emergency fund is much more important than probably a trip. And in a long-term goal, child education or retirement planning much me could be much more important in general. So you'll always have to prioritize something and deprioritize something while planning because you only have limited savings and limited investment options, which don't give you extraordinary returns, and you can't just multiply your money and get disproportionate returns as well. So there are many different things like what's the importance of the goal or how urgent or important it is. So things like this will help you to prioritize certain goals over others. Like it is said, like focus on important goals, like your emergency fund, your insurance, your retirement, and if the let's say client is very old, so estate planning will making the will of the client. So based on many different factors, one should decide what is important for the client and appropriately deal with it. There is one more thing. There can be some things that have very short horizon, like emergency fund needs to be made now. There is a trip that the client is planning for 1 year. So for that, planning has to be done differently. And let's say for a 5 year goal for child college education, which requires much more bigger fund for let's say 5 years from now, that requires a different planning. Although the plan has to be presented at the same time, but putting different goals in different baskets, like the trip is in short-term goals, the child education is in long-term goals. So they should be put into different baskets, prioritized differently, and uh, plan should be made accordingly. Uh, for the exam and in general, this technique, SMART as it is called, so S stands for specific, M for measurable, A for achievable, R for relevant, T for time bound. This philosophy has to be, this acronym is something to be remembered for exam as well as in general. This is a very powerful framework to be used. So, what is specific? So, your goal should be specific that you want to achieve. Who, what, where, why is something you should ask your client and find the answers of to formulate the goals and put them into different baskets. Measurable. So if you can't measure it, it will be very unlikely that you will achieve it. So for the trip, you need 50,000. So you know 50,000 needs to be saved, or the final outcome of your investment should be 50,000 at the end of 1 year. Child education requires 10 lakhs now. So in 5 years, that 10 lakh would be 15 lakh, let's say. So at the end of 5 years, you need 15 lakhs. So for that, what's the return in the market? So back calculations will help you as to how much SIP needs to be done. So measurability is a one important factor while setting goals. Now that doesn't mean you have to get to exact number. There can be a range to, let's say today the education costs between 9 to 11 lakh. So in future it could be anywhere between 14 lakh to 16 and a half lakhs. So if it is measurable, you can let's say take 16 lakhs on the upper end and then back calculate it. So even if the client has to save a little more, or we'll have to go into a little more riskier asset which gives more returns. So that is a little gray area, but measurability helps in determining what asset and what amount of allocation to that asset is required, achievable. So in achievability, what's the most highest return giving asset currently? It's equity markets. Let's say it's 15% per annum on an average on a 5 year basis. So which means 15 years, 15% for 5 years is basically twice your initial capital. But if the client has 10 lakhs and he wants to achieve 30 lakhs in 5 years, so that might not be achievable. For that risk to be taken could be very out of proportion to what he might have the capacity of. Relevant. Uh, is he, is the client uh, has some goals which are totally irrelevant, like spending on luxury or anything extra or exorbitant that the client might be doing, or any expenses that he has that can be cut back. And what is the relevancy of that goal will also help you prioritize it, like insurance, like retirement planning and emergency funds, estate planning if the client is very old. So, what's the relevancy of that goal? And it has to be time bound. So, some goals need to be achieved first. So, for that, let's say for your trip, you have only 1 year to save and then you have to take the trip. For the child education, you only have 5 years to save and uh, finally pay up for the college education for your child. So these are time-bound things that needs to be completed in the time that you have, and most likely cannot be postponed. So this whole acronym of SMART, specific, measurable, achievable, relevant, and time-bound, is something to be kept in mind, and is highly testable in exams as well. The next part is cash flow management and budgeting. So every month, the client has some income out of which he does some necessary basic expenses, pay off his EMIs, spend some extra, and then what is left is the savings. This savings can then be utilized to make investments and proper asset allocation for the client. Also, there is budgeting. So, what does the client spends on is also something to be looked at. If there are expenses which could be cut down, so should they be cut down? If the client has to save more in order to achieve the goal, so then that expenses have to be cut down. So that's budgeting. Uh, let's discuss a case wherein a client has too many expenses and wants to save a corpus for his family. So the client needs to invest, let's say 20,000, but because of his current expenses, he's only able to save 15,000. So the gap in savings is 5,000. When you will do budgeting, you will find that certain expenses can be cut down, brought down. So the extra 5,000 can be saved. So that is a case by case basis. Then comes the insurance planning. Insurance is something that we give to the client, but it is the ultimate beneficiary is not the client himself. It most often is the family or the dependents of the client. And in insurance planning, every month you have to pay a premium. So part of the saving or gross saving should be going into insurance planning. Like you are paying your EMIs, you should also be advising client to pay all the insurance premiums at time so that there is no penalties or your insurance plans doesn't get void. Debt management and counseling. Sometimes your client might have not just one outstanding loan or credit card, but many outstanding loans, such as uh, how home loans are usually one, most likely they don't have two. There can be a vehicle loan, there can be gold loan, there can be multiple credit cards. Credit cards is where there are more than one credit cards, and so many a times uh, client convert it into EMI, but the EMI mounts over each other, and there is a huge uh, hole in the budgeting. So client is not able to save, let alone invest. So there, all the loans might have to be converted into one loan because of the because different loans might have different interest rates and different EMI needs to be paid at different points. So maybe consolidating all the loans, maybe restructuring needs to be done to get all the loans in one and one interest and one EMI, or certain bigger loans like the home loan is a bigger ticket loan. So the tenure can be extended to get down the per month EMI so that the budgeting can be done more properly. It is a very nuanced topic, but it is very relevant, and in many cases, the client uh, doesn't understand this, but the client needs to be handholded, and uh, the final plan needs to be made in order to achieve his financial goals. The next is investment planning and asset allocation. So after that, you have saved the money for the client, then it needs to be passed to the investments. So what is the investment plan like? Uh, he has higher risk appetite and he doesn't have any specific goals. He just wants wealth creation. So uh, much of the money can be moved to mutual funds. But let's say the client is nearing retirement. So the money should only go towards short-term debt funds or FDs or some tax saving instruments which pays interest regularly. Asset allocation is very important, but is very nuanced. It depends on the age, risk appetite, time left for the goal, etc. things, which we'll learn in depth in different chapters in this module, in this level one, and also in level two. Then there is tax planning. So certain instruments have tax planning when the income is received. So if you do the investment then itself, like PPF, your income gets taxed at a lower rate. Sorry, it doesn't get taxed. It is exempted. Then there are instruments on which if you get interest, the interest is tax deductible. It doesn't get taxed. And there are ELSs wherein if you invest, the money goes into mutual funds and are invested in the market. But certain instruments come with certain liquidity constraints. So ELSs is something that is blocked up for 3 years. There are tax deposits wherein the money you deposit now, you get tax exemption now, the interest is exempted, and on the redemption, everything is exempted. But that has a liquidity constraint of 5 years. You have to keep your money for 5 years for it to be made tax free. Then one more need is retirement planning. Uh, Everyone wants a nice, smooth retirement. Some people also plan for retirement homes, etc. things. So retirement planning is not something that should start late. It is something to be very high up the priority list. So more the time you have for retirement planning, the better it is. The lesser you have to save, the more time you have for the markets to generate returns for you. So these are the things we should take care of. As for me, it should start at the earliest, but it should be made a very high priority if the client is already above 28 or has just entered 30. So retirement planning is a long process and is very important. We'll talk about retirement planning in the upcoming chapters in detail, and retirement planning itself is a module in the level 2 of the exam. Then there is estate planning. So what is estate planning? Estate planning is basically passing on your assets and liabilities to your legal heirs or your family members or dependents. So how it is done, why it is done, what's the process, estate planning itself is a module in the level 2. We'll discuss more of it in next chapters. Now moving on to the next topic, which is concept of asset liabilities and net worth. So asset is basically what you own, liability is what is owed to other, and net worth is the difference of the two in general. But asset liability net worth has different meaning for a company as we generally study, and it has different meaning for a person. Uh, as we already understood that the client has certain income out of which he does some expenses, then he is left with the savings. Every month he has some savings which he would invest in. And on the he already has some investments, he is making more, and that creates his network. He also might be having liabilities such as home loan, credit cards. So out of assets, you deduct your liabilities to get the net worth. There are many different types of assets, type of liabilities, and net worth in general is of two kinds. I'll tell you about that. Based on the assets, assets can be physical assets or there can be financial assets. Physical assets such as gold, your real estate, and any other collectibles, etc. Financial assets are everything else like your it can be in debt instruments like FD, bonds, ultra short funds. It can be mutual funds wherein you have equity mutual funds, hybrid mutual funds. It can also be direct equities. It can also be your any other fund that he might have invested in like AIF, PMS, etc. So that all needs to be taken into account. And if he has some inheritance also in form of trust or etc., that also comes into the asset side. In the liabilities, liabilities are generally of loans that he has. So the loans can be of home loan, vehicle loan, gold loan, any other personal loan, education loan, credit cards that have EMI attached to it. After deducting the liabilities from the asset, you get the net worth. But there are two kinds of net worth. One is the basic, which we say net worth. It inculcates everything. But then there is a liquid net worth. Like you have a home of let's say 1 crore, and you don't have any other liability, major liability. You also have other assets like um, investments in mutual funds, let's say 20 lakh, and you only have a small personal loan of let's say 5 lakh. So on pen and paper, it will seem like 1 crore plus 20 lakh minus 5 lakh. So 1 crore 15 lakhs would be his net worth. But one thing we should consider in mind that for any practical reasons, he's not gonna sell his house which he's living in. So practically that 1 crore has to be kept out of the liquid net worth. Like he's not gonna sell it for all the practical reasons. So you should only take the 20 lakhs minus 5 lakhs. So his liquid net worth, what he can redeem right now and get in cash, is only 15 lakhs. We are not here discussing about the emergency funds. Let's say he has emergency funds also, etc. So that gets added. But his liquid net worth, which usually is outside his home, also let's say you exclude his vehicle, like he's not going to sell his vehicle. So these are major is the home he's living in. Second might be his car and etc. things which he uses on daily basis, which he might not be willing to sell in general, or the assets that cannot be sold off very quickly, let's say within a month, are generally excluded while calculating assets for liquid net worth. Thank you, and we will meet again in the next lecture.